With Basant Maheshwari, who is joining in. Basant, hello there. Good morning. It's been a while that we've chatted with you. So much to really talk about because this momentum and the gusto with which the market is moving has definitely come as a positive surprise. Look at where we are, gradually making our way to the coveted 13,000 mark on the index. What is it that you're advising one to do? Because the opportunities to dip in seem to be very limited at this point in time, given this meteoric rise.
Good morning, everyone. The opportunity is limited, obviously, because if you go back to your textbooks, this is like completely out of the syllabus. Nobody knew what's happening. Even while COVID was on, people refused to believe the artificial lockdown and the slowdown that was imposed, because when you lock up the bars at their home, and that was a global event. And the bars and the sellers, when they cannot meet, when they cannot transact, obviously the GDP will collapse and things would happen. What we got in hindsight, I think at the cost of being a little too greedy and too brutal about my market, I would say what we got in hindsight was more than a fair deal. And I will say that because we wouldn't have got $8 trillion of liquidity floating around the globe had COVID not happened. COVID is now behind us, but the money stays back. So in school, high school economics, we learned too much money chasing too few goods is inflation, and there's inflation in the stock market.
Oh, yes, indeed, out of syllabus for everyone, as I think everyone's just been taken aback by the kind of move that we've witnessed. But let's talk about the situation then with banks. One needs to be very particular as well while picking out these names, because while a lot of them have given you handsome returns within the private financial space, you have burnt your fingers with a number of names owing to multiple issues. So what is it that you're advising when it comes to approaching the entire BFSI gamut, if you will?
I mean, there are two ways to look at it. If you have a 5-year view, then obviously, and nothing that I speak about should be looked at as a recommendation. If you have a 5-year view or a 3-year view, then you would definitely want to go with the Kotak banks and the HDFC banks. But this is not the time to buy the best of the best. This is the time to buy banks that have survived the onslaught, cleaned off their books over the last 4 to 6 quarters, have a provision coverage ratio which is hitting mid-70s from mid-50s or 60s. And this is the time to get your hands dirty in banks that are trading at one-time book, which have been adequately funded. So it's a little different from what we've always spoken about, because this is not the time to play defensive. This is not the time to go around looking for stocks that won't fall. This is the time to get a little adventurous and not buy those second quality banks just because they're going to grow back at 20%, but buy them because there would be a re-rating happening. Banks that have survived the onslaught can't trade at one-time book. I mean, a banking license is worth $1 billion in India. And even if you have $1 billion, the RBI won't give you a license. So that's a proper way of looking at it and approaching it. But yes, this is not a 5-year investment. This is not a 3-year investment, but it is very much what investors who have some idea of what they are doing should be looking at.
Vasant, some would argue that, look, in banks, the market share gain is obvious. And if today customer has to go, they would choose an HDFC bank over RBL, or perhaps they would choose some other franchises when it comes to even giving deposits. So yes, these banks are cheap, but their cost and their NIMs and their deposit growth is not great.
Because they were priced for bankruptcy. And once a stock is priced for bankruptcy, you want to sell it even at 1 rupee and recover whatever you've got. They didn't go bankrupt. They got PE funded. So you have to price them as a going concern now. So there's a huge gap in pricing a company for bankruptcy and pricing it, assuming that they're going to stay and be alive for the next 5 years. So any bank that you think should be alive for the next 5 years and is trading at one-time book or 1.1-time book, and the book right now has been cleaned over the last 4 quarters, the managements have changed. So the new guy who comes in obviously wants to start from a low base. That used to happen at the State Bank of India level almost for the last 20, 25, 30 years that I've been watching that stock. So when the books have been cleaned, and what gives you a sense that the books have been cleaned or not cleaned is a provision coverage ratio of maybe 75%. You can have one more quarter of write-offs. So you don't play them for growth. You don't play them for a theory that they're going to survive the next 50 years. Of course they would. but you play them for a valuation catch-up, and that's what people would like to do in this kind of an environment.
Outside bank, what else are you looking at?
So you would have to look at something that survives a lockdown. And I say this not because you want to protect money. So obviously the last few months we thought that why not buy liquor companies? But you don't just want to buy a company to survive a lockdown, because if you want to survive a lockdown, you go and do a bank fixed deposit instead. So you would like to look at consumer companies. You would like to go look at companies that are maybe in the restaurant business, maybe supplying food or quasi food or whatever it is. Or maybe you would like to look at rural themes. So when I say rural themes, it can't include fertilizers, because if you sell fertilizers, the government won't let you charge too much. So there are specific rural themes that would benefit from the new improved Banrega that the government has announced and things like that. So across the board, there are several opportunities in the mid and the largest mid-cap space. So maybe from a 15,000 crore market cap to a 50,000 crore market cap space. So I think that's the spot to look at. And then there are several companies right now to choose from.
So let's talk about some of those companies, Basant. I mean, would you go very stock specific? Are you looking at some micro themes perhaps within those broader markets?
No, I mean, if you would like to understand what I'm talking about, each of these should be a leader in its segment. So you don't buy the second. I mean, in a bank, you can buy a second one because you're playing for a different game altogether. You're playing for a re-rating for a one-time book to become a two-time book or 1.5-time book. So even if one-time book goes 1.5, you make 50% in the interim. But in these themes, you have to understand that you have to buy the companies with the same format, with the same pattern, return on equity in excess of 25%, a top-line growth nearer to 20%, a bottom line that can expand with the top line. Because I think one thing which COVID has taught all these companies is that you can still survive and you can do business even while bringing down your costs by 20%. So you would like to look at companies that can stay at 80, 90% cost levels, but a lower cost is bad for the economy. So if I'm not spending, I'm hitting somebody's income. So if everybody starts cutting down their expenditure, I don't know how much the GDP would survive. So beyond the point, you don't want the cost-cutting exercise to go at a macro level, but at a micro level, at a company level, cost-cutting is great.
Is the reopen trade something that you're looking at as well? Sectors that have been extremely hard hit, but would you still perhaps look for opportunity in leaders in those segments, whether it be aviation, travel, hospitality, with an eye to the recovery?
I mean, there are not too many options to play for in India. Of course, if you're investing globally, there are several options. So two things which I can tell you which will do well, but for example, we don't own it. Indigo. So you would say I would buy the poor cousin SpiceJet. You can do that, but you know the stability of your mind when you buy an Indigo, for example, it's already run up from 900 to 1700. So then so have all the other companies. Another thing that you would look for is real estate companies would do kind of okay now. So, but real estate investors might not do okay, but real estate companies might do okay, because Maharashtra is the real circle that pushes real estate in India. And once there is money flowing from Maharashtra, it flows all over across the world, across the country. So real estate companies would do well, but then most of those companies there are very shady. You don't know what they're saying and what they would do. So there are ways to play it, but why become a compulsive sector allocator? Just pick up your company and buy it. Just because real estate is doing well doesn't mean you have to buy all the real estate stocks in the town.
Would HFCs be any way, or ancillaries like cement, steel, etc., Basant, which would be of interest?
Cement is already showing strength. Steel, I read somewhere, China's stimulus is expanding the steel demand by 30-40%. So China itself is the big hungry dragon that has again come down to the dining table. So I think China is going to, and there's a huge trade happening. I think the next 15-20 days, we would know whether we are revisiting a 2003 to 2008 kind of an environment where there was huge money flowing into emerging markets. See, for the last 5 years, from 2015 to 2020, FIIs have been a net seller of Indian equities. I mean, you can go a few thousand crores here and there. The last big money that they put in was in 2014. So beyond that, with this 8 trillion, money will come in. So you can argue whether it makes sense, whether your DCF is matching, whether the future is really as bright as the stock market is telling you, but who cares? I mean, let's try and consolidate our future and then move ahead. It's a party on liquidity, and it's going to stay this way at least till something worse happens. But one thing is for sure, most would tell you what happens if this liquidity stops. I think this liquidity that the government has initiated at the US level wouldn't stop, because if it stops, the entire globe will come to a screeching halt. So whatever we have got it, we will keep it at least for the next 1, 2, 3 years. And it's incorrect to put an upward limit on how much money can flow into India. We've just seen how much the FIs have bought over the last few days, and still year to date, they are negative. So, and plus one thing which is there, Aisha, is the retailer still is on the sidelines wearing his mask, both on his mouth and also on his eyes. I don't know why I say this, but I think it's going to be the same story again. They're going to be a big jump of retail trade into the Nifty or into the bank stocks, into across the board, and then only we will see a meaningful correction. This market doesn't stop unless it's sucked the last retailer in.
Isn't that always the case? Okay, so Basant, you've identified many new sectors where you think money is going to move in. Is that going to come in at the cost of what has already done well till October end? IT, Pharma, Reliance Industries, and some other names. Will they then go into both time-wise as well as price-wise correction?
I mean, the big baddie of all is telling us America. NASDAQ isn't doing so well. The more money is flowing into the JP Morgans, into the Wells Fargo, into the Dow Jones companies. So one stock, what we identified, we had bought and we had sold off also was Reliance Industries. During the lockdown phase, we bought and we sold. So that's one part to it. But I think the entire trade is shifting because IT, Pharma, defense, where defense is. So when has Pharma done well in India? If you just go back, when has IT done well? 1994 to 2000, the IT did well and the Sensex went nowhere. 2000 to 2003, I think Pharma did well and the Sensex went nowhere. 2009 to 2015, Sun Pharma and most of the Pharma index, the Nifty Pharma index hit an all-time high and the market went nowhere. So IT and Pharma does well when the markets go nowhere. But if you would see that there is a huge trade happening, there's a huge flow of money happening. It doesn't flow into IT and Pharma. IT and Pharma fund managers like us, when we get into a compulsive mode of remaining invested, we say, chalo kuch lena hai to Hindustan Lever hi le lo. Kam se kam cash to nahi dikhega investors ko. So I'm not saying Hindustan Lever is good or bad, but this is just one way of doing it where fund managers don't want to hold cash, but yet want to show their investors that they are invested.
Mr. Maheshwari, let's understand where the market is positioned. The market currently is betting on survivors. The market currently is betting on companies which in a sense have managed to survive the COVID crisis. How will you call PSUs? They are deep value. Are they non-survivors or they are just stocks which are getting ignored and they will also come back?
I would not look at PSU unless I knew that somebody is there with his checkbook trying to buy out one PSU. And still, I think it's better to buy that PSU after it has been privatized. For example, Hindustan Zinc went from 30 odd to 1,000 rupees in the year 2001 after it was privatized. So there are oil marketing companies that are being privatized. See, Nikunj, the basic problem in a PSU is when you pay so much dividend, you don't have money to expand business. And most of the PSUs are cash guzzlers where they need tons and tons of cash. I mean, an oil company, for example, a coal mining company, if they pay you back so much cash, where do you get the money to plan for expanding capacity and expanding output? So if you have a 5-year view, I don't think you should be buying any of the PSUs. So there is a shipping company, there are shipyards or dockyards which give you 3, 4, 5% dividend yield. That's good for somebody who's looking for a yield, but then you want the yield to come down because it is only that when the yield comes down that the price goes up. So a stock that gives you 5, 6% yield is good for comfort, but it's not great for capital gains, I would suggest.
Okay, I'm just going to talk about Mahindra and Tata Motors and what is happening there. Since we are talking about forward-looking sectors, Mr. Maheshwari, Does it make sense to avoid autos completely, given that the world is moving towards EV and American markets, which are the mother market? They are telling you that, look, we like Tesla more than other auto companies, and Toyota's market cap is now nowhere close to Tesla. Does it make sense now to avoid into auto stocks? Because if markets are moving up because of global flows, global investors would be cognizant of what is happening in their backyard, and they may not like to buy Indian autos.
See, you can't buy an auto company to fund your child's college education, because by the time he reaches college, these companies would be redundant or they would have to change their game. But the important part is the change that we see happens very slowly. I mean, there's just two changes in the world that have happened fast. First was the internet and the other was the mobile telephony thing, because you just couldn't do without them. I think for the auto business also, you cannot assume so much of change to happen over the next 5 years. But the change would be more pronounced in terms of stock markets, in terms of the valuation that we give to these kind of companies, because over a period of time, if things are supposed to change, the market assumes the change much before the change actually happens. So to that extent, you can play them as a reverse trade, as the stocks that have been beaten down and might go up. But if you have a 10-year view or a 15-year view, either Maruti has to change itself or survival would be difficult. So it is with that intention that you should buy these companies, rather than just thinking that these things would change and these companies would not go up, because they would go up. I mean, nobody's buying an electric car from January onwards. This change would happen very slowly. Tesla is not even right now in India. It's going to take at least 5 or 7 or 10 years to come into India. But that change would be very small, very slow, and very subtle. So you can't actually base your trades on that change.
Of index upgrades coming in, given the kind of momentum and flows that we're riding on currently. Do you also see that wave continuing into the new year? We also got all this positive news on the vaccine. So given that all data, at least for the moment, seems to be pointing to a higher trajectory for the markets.
So the market has changed its thought process. From 6 months back, it was whether we will have a vaccine over the next 12 months or we will not. Now the question is, when will we have a vaccine? Maybe March, April or May. So when the market is not too bothered about, they say, chalo, theek hai, March mein nahi aayega, April tak aa jayega. Na? That's how it is. But about these upgrades, obviously, I mean, most of people look at the price and they say, we're falling well short of where the Nifty is. So let's not look a little out of context and let's upgrade it at least to 5-10% more. Because I would have liked to see the upgrades before the Nifty moves up. But normally upgrades come after the prices move up. That's how the brokerage industry functions. So I can't say much on that.
And where are you with regards to valuations? Because there was an interesting thought that suggested if you actually look at where we're currently at with earnings and so forth, that valuations aren't as steep as one would initially think, and there is still room for further gains when it comes to some of the key names that we continue to talk about. Would you agree, or do you feel perhaps that things are looking topped out?
So as a fundamental analyst, you get down and you say, this doesn't seem the standard valuation stock. This doesn't seem to conform with the standard valuation metrics that I actually think about. But then who are we to decide value? The basic theory in finance is P multiple should be 100 divided by interest rate. So if interest rates were 10%, so 100 divided by 10 gives you a P of 10. So what would be the P if interest rates are 0? Would you say infinity? No, we wouldn't say that, but they're still kind of like that. So what would be the P ratio when the interest rate is 1%, for example? The P is 100. So because money always have alternative uses. Either you can buy gold, or you can put it in a fixed deposit, you can buy real estate, you can do stocks, you can put it under your mattress, or you can gift it to a friend. So if you look at it in that context, when you don't get that much money from your bank fixed deposits, obviously the money chases stocks. So as much, and interest rates is one big dragon that the world cannot afford to let go again. Because if interest rates go back to 3%, most governments will go bankrupt. They've taken so much of debt. Most corporate citizens, most retail citizens would go bankrupt. So the world is in a situation where it would try and keep interest rates low. So what's the end game? The end game is a disaster. But what if the disaster happens after 50 years? What if we don't live till then? So Right now, the basic thing is you just see what is happening and play it by that rule book rather than try and assume that the book that you have read, which was written in 1930, is going to be operative in 2020, because the world has changed. I don't think anybody has done some serious study or anybody has written some serious literature or papers on liquidity and their impact on stock prices. Yes, there have been articles, but nobody has done a complete exhaustive work on this. I think this demands immediate attention.
Okay, Basant, great to have you on the show. Thanks as always for taking the time out and joining in today.